Ladies and gentlemen, good morning. My name is Joel Lescote. I'm the Director of Dealer Development for NIADA. That's the educational arm of NIADA. Well, today's panel is rather interesting because it's all about the money, and hopefully we'll be able to show you the money. In terms of finding the latest in accessing capital and financing for your customers, selling a car is a lot easier than oftentimes finding financing, so today's panel is all about finding capital. You may not need them today, but who knows, you might need them tomorrow, so listen up. You've got an outstanding panel of experts this morning. It's going to be led by a moderator, LJ Marhefka. I don't know if any of you have had the opportunity or pleasure to meet LJ. A little powerhouse in helping to find financing sources. As a matter of fact, it was through 2009 and 2010, in part with NIADA, that LJ and NIADA and a group of dealers, about 200 at a time if I'm not mistaken, were out and trying to improve lender relations. And in order to find lenders who are willing to who are willing to donate, or not donate, but rather to improve lending sources during some very, very critical times in our country. I'm going to turn the panel over without any further ado to LJ Marhefka, consultant with LJ King. LJ?
Mr. Lescote. Thank you, sir.
You had me scared.
Don't be scared. Good morning and welcome. Welcome to Las Vegas and welcome to the NIADA Convention and Expo. The world moves faster every day. Are you ready for what tomorrow brings? Today we have the great opportunity to discuss dealer capital and lending relationships with a handful of the industry's finest dealer capital and lender partners. And I have to tell you that during the financial crisis of 2008, their commitment to us and our industry did not waver. These folks, along with the folks that you'll be meeting this afternoon for our lender one-on-ones, have been here for you and will remain here for you. With no further ado, I'd like to introduce the panel. To my left, everyone's to my left, right? Joe KEADLE, Automotive Finance Corporation, MACY MEYER, Chase Finance, Martin Less, Nationwide Acceptance, Alan Lang, Next Gear Capital, Doug Pitcher, United Acceptance, and Mark VAZQUEZ, Westlake Financial Services. Gentlemen, why don't you tell us a little more about yourself? Let's start with Joe. Tell us about your company, a little bit about you, and how you might be able to help these folks.
Just a little bit of background for the folks that may be unfamiliar with AFC is we are active in the U.S. and Canada with a little over a 100-branch network. Myself, I've been in and around the automotive business for, I think, about 18 years now. It kind of, you lose count. But I've sold cars. I've been an F&I manager, used car manager, new car manager, switched sides and went on the banking side, and have been on the primarily commercial lending floor plan side for probably about 10 years now. And I'm the current VP of the West for AFC.
My name is Macy Meyer, and with Chase Auto Finance, I've spent, I guess, 27 years in the auto finance business, all with Chase or a Heritage Chase organization, in a variety of positions, bought paper, collected, managed a center, then kind of ventured off into a thing called product management, where we set the pricing and that kind of thing for all of our products. Spent some time in the e-commerce world. Actually was able to visit with some folks last night. I'm talking back in the 90s when the internet was going to change the world, and of course it did, but in a different way than we thought at the time. And then from there, was a national sales manager for a brief period of time. And most recently, for the last 5 or 6 years, I've been managing the credit in the western part of the country for Chase.
Thank you, Macy.
Good morning, I'm Martin Less, and I'm the President and CEO of Nationwide Acceptance. For those of you who are unfamiliar with Nationwide, we are a subprime point-of-sale lender. We do business in 23 states. I came to the company back in 1995 as the Chief Operating Officer and have gone from there. We've expanded from just being mostly a Chicago Central finance company to 23 different states that we do business, and our niche is really between an AmeriCredit and a credit acceptance.
Excellent. Thank you, Martin. Alan.
Good morning, I'm Alan Lang, NextGear Capital, Vice President of Operations for eastern part of the United States and Canada. NextGear is the culmination of the merger between Manheim Automotive Financial Services and Dealer Services Corporation. It took place in 2012. We do business in all 50 states and Puerto Rico. Our main product offerings are retail and wholesale lines of credit on the commercial side for independent and franchise dealers. We operate in 180 markets through a field force of account executives and in also 50 locations throughout the United States with sales executives.
Thank you, Alan. Doug?
Good morning, I'm Doug Pitcher. I work with United Acceptance Incorporated. My position is Director of Sales. I oversee all sales operations outside and inside. United Acceptance has been around 22 years serving dealers in the subprime auto finance sector. We primarily specialize in buying bulk accounts. We have other products as well, but that's really our specialty. We're based out of Atlanta, Georgia. The company is run, it's a private held corporation. The three owners that run the company used to be buy here, pay here dealers. So they've got some inside knowledge on the transition process and how they can help you grow your business.
Thank you, sir. Mark?
Good morning, my name is Mark VAZQUEZ. I'm the Senior Vice President of Sales and Marketing for Westlake Financial Services, and we buy point-of-sale subprime contracts at a full spectrum level, so from zero FICO all the way up to 800 plus, all within one platform. We're in all 50 states, and we have about 310 account managers throughout the country to service the dealerships. Along with the indirect piece that we also have bulk purchase, we also have flooring, and we also offer a DMS through our sister company, Nowcom, which is called Dealer Center.
Mark, thank you. Incidentally, there was a great article in Forbes magazine about your company and your founder. It was very interesting. If you'd like to read it, I'm sure you can research that. Well, dealers, let's talk a little bit about you. Fair enough? That's why you're here, I think, to meet people, to increase your business. I've got some nice statistics for you, courtesy of the NIADA. It's actually hot off the press. The used car industry report is something that they publish annually, and it's a great compilation of data that helps us understand each other, helps our vendors understand us, and helps the outsiders understand a little bit of who we are. I want to congratulate 41% of you, because according to those statistics, you've been in business, in the car business, for over 21 years. 65% of you retail vehicles that are 5 years old or less. About half of you finance some, most, or all of your customers in-house or buy here, pay here. While the majority of you use banks and financing companies for your customer financing. Independent dealers are responsible for about 48% of all used vehicles purchased at the dealership level. It's about 14 million vehicles annually. We do continue to have our work cut out for us as we are losing slightly to the franchise folks. Private party casual sales are losing market share to dealers. It does appear that the public really understands our value proposition. There are about 38,000 used car dealers and only 17,000 franchise dealers. I think if we team up, we can beat them. You guys agree? Amen. 82% of you have a dealership website. That's just 4 out of 5. That means 1 in 5 don't have one. Now, perhaps these statistics are skewed, and perhaps these reflect dealers that are just in the wholesale business. You should have received this NIADA used car industry report in your welcome package when you registered at the NIADA desk. If you've not received it, I would suggest that you visit the desk and ask for one. A lot of valuable information. An interesting note with respect to that, it's interesting to see how the certified master dealers are performing as compared to the rest of the industry. Joe Lascota, where are you? Joe's way in the back. Joe, you're doing something very right. Joe runs the Certified Master Dealer Program, also runs the NIADA 20 groups with the help of Georgia Brown. Joe, can you stand one more time so everyone can take note? Folks, I encourage you, it's a gentleman in the back waving his hand vigorously. I encourage you to visit with Joe at some point throughout the convention, at least to discuss the possibilities of becoming a certified master dealer or joining an NIADA 20 group. I'm also looking forward to seeing how the 20 group information compares to the dealer composites. Joe, do you think we can get that done? I appreciate that. I already figured as much. Thank you. 20 groups are a great way to get together with your peers in an effort to increase your business. I want to take this time to thank the NIADA, Mike Lynn, Steve Jordan, and the entire NIADA staff for continuing to provide great products for our industry through the 20 Group Certified Master Dealer, the industry reports. Will you please join me in a round of applause for the NIADA? Thank you. Okay. Let's talk a little bit about the hangover. Not how you're feeling this morning, because you guys look really good, okay? And I'm not talking about the movie they made right here in this hotel with Zach Galifianakis, Brady Cooper, and a host of others. I'm talking about the hangover that most of us have lived with after the financial party we enjoyed prior to 2008. I'm sure we can all agree that that hangover is now over. Today is a great time to be in the automobile business. So we're here to discuss automobile finance. Auto loan delinquencies and repossessions rose in the first 3 months of 2013, suggesting that dealers and lenders have resumed selling cars to consumers who may be a high credit risk. A May 14th report from Experian's Automotive Credit Unit shows that 30-day and 60-day loan delinquencies increased considerably by 1.3% and 12.4% respectively when compared with the same period in 2012. In absolute terms, the total amount of auto loans given out in the first quarter of 2013 grew by 9.6% to $726 billion, compared with $663 billion in the first quarter of 2012. There's some bad news, though. The average charge-off for bad loans rose more than $600 from $67.39 to $74.01, according to the report's findings. And car repossessions surged by 16.9% year on year, going to 0.50% in the first quarter of 2013 compared to 0.43% in 2012. Charge-offs, however, are still well below recession levels, as the first quarter in 2009 average charge-offs were $10,126. So while your lender charges off a loan, you folks have to collect quite a bit of interest to make up for that. Is that correct? And even for the dealer capital partners like Automotive Finance Company and NextGear, when you guys have charge-offs, it takes a lot to recover. You have to do quite a bit of business. The report also noted that while repossession rates for banks, captives, and credit unions were down year on year by almost 15%, repossession rates for finance companies increased by more than 52%. I'm sure this statistic also includes finance companies that are dealer-related, thereby skewing that number. We should start to see more increases as some of the subprime loans coming onto the books begin to deteriorate. However, one thing most lenders will agree upon is that today's subprime borrower is less delinquent than those in the past. During the recession, only buyers with the best credit could get loans. Now, lenders are relaxing restrictions and sanctioning riskier loans, once again creating scenarios where default rates could rise. However, despite the recent increase, repossession rates are still relatively low as compared to the 0.71% peak reached in the first quarter of 2010. Also in March of this year, Experian Automotive released that average loan terms for used vehicles stayed flat at 60 months. Findings from the fourth quarter State of the Automotive Finance Market Analysis showed that the average interest rate for new and used loans dropped in the fourth quarter of 2012, and average monthly payments dropped versus the same time period in quarter four of 2011. Overall, quarter four 2012 was a very favorable time for customers to buy a new or used vehicle in terms of overall monthly payments. Lower interest rates and longer loan terms made it easier for customers to finance a vehicle while keeping their payments affordable. This, combined with the fact that more vehicle loans went to consumers with credit outside of prime, portends a vital and healthy automotive market. However, while consumers are taking out larger loans, lower interest rates and longer loan terms for new vehicles help bring down the average monthly payments. For example, the average interest rate for a new vehicle loan in the fourth quarter of 2012 dropped to 4.36% from 4.52% in the fourth quarter of 2011, while the average interest rate for a used vehicle loan dropped to 8.48% from 8.67% in the fourth quarter of 2011. More consumers also were able to obtain financing in the fourth quarter as average credit scores for both new and used vehicles dropped. For new vehicle loans, the average consumer credit score was 755 in the fourth quarter of 2012, down 6 points from the fourth quarter of 2011. For used vehicle loans, the average consumer credit score dropped to 665 in the fourth quarter, down 5 points from the fourth quarter 2011. Other findings from the fourth quarter report: automotive loans for new vehicles with terms from 73 to 84 months increased by 19.4% over the fourth quarter in 2011. That's quite a long time to finance an automobile. New lease share of new financing increased to 24.79%, up from 23.1% in 2011. The total subprime market for all new vehicle financing increased by 9.7% to 24.77%, up from 22.59%. Total subprime market for all used vehicle financing increased by 3.4% to 55.4%. Up from 53.58%. Buy here, pay here organizations and credit unions showed the strongest market share growth. Buy here, pay here's grew at the rate of 4.3%, and credit unions grew at the rate of 3.9% for overall automotive loans. However, banks have the highest market share of automotive loans at 41.2%. CNBC reports 43.2% of new car loans in the fourth quarter were written for those with subprime credit scores. That's the highest percentage of new car loans going to subprime buyers since 2007. CNBC also noted as the economy has slowly improved, lenders are increasingly comfortable writing auto loans for subprime or weak credit ratings. And by the way, about 85% of all retail sales, automotive retail sales, all 85% of those purchases are financed. Subprime loans accounted for a higher percentage of the total at 35.4%, up from 34.9% a year ago. While that's still short of the level of nearly 40% in the first quarter of 2009, it's an improvement. Experian Automotive defines subprime credit as loans with a credit score below 680. Rebounding since the recession, the subprime auto loan industry is forecast to grow over the next 5 years, thanks to rising new car sales, improving consumer finances, and continued strong demand growth from subprime borrowers and investors. With interest rates dampening returns on traditional asset classes such as stocks and bonds, investors increasingly sought higher investment returns from riskier assets, such as subprime automotive securities over the past 3 years, facilitating the subprime auto loans industry recovery. Historically low default and delinquency rates on subprime auto financing have also attracted investor demand, driving up total subprime loan volumes. Higher volumes and falling losses have brought industry profitability back up to just below pre-recessionary levels. New car sales, improving consumer finances, and continued strong demand growth from subprime borrowers and investors are forecast to spur industry growth over the next 5 years. Faster growth will be restrained by rising interest rates, though. That will raise borrowing costs and slow vehicle sales. Still, stronger subprime borrower finances and access to credit will sustain demand growth over the next 5-year period. Over the next 5 years, strong demand for vehicles and improving industry profitability will attract new entrants. Despite increasing scrutiny across the financial sector, as part of the 2010 financial regulatory overhaul, low barriers to entry will encourage companies to tap into the subprime automotive lending market. Furthermore, existing firms will continue to expand their geographical foothold to take advantage of growing demand from new subprime automotive buyers. Well, that's a brief report on automotive financing, but I'd like to hear from our panelists today. By the way, this venue is about you. From here on out, this is going to be a conversation. I'm going to turn it over to the panelists, and we'll turn it over to you. There will be folks walking through the audience with microphones. We're looking for a conversation. Here's a place to ask your questions. If you are looking for something in particular, ask the question here. Later today, in the Milano rooms, from 1 o'clock in the afternoon till 5, you can have intimate time with your particular lender. There are more lenders than are represented on this panel. So I do encourage that. Some questions for our panelists. If you guys can just each take a shot at this question, I would appreciate it. Then let's just start with you, Joe. With respect to the market you serve within our industry, what do you find most challenging for dealers?
I think you actually touched on it, and when you were going through your statistics, it's the cash flow of a dealership, but then one of the things that's very interesting, if you look at it on a glass half full basis, when you talked about repos being up, that's actually one of the production lines in the imaginary used car factory. All of us are very concerned about how you're going to source your inventory, how you're able to access these vehicles at the least amount of cost, get your recon done and get them frontline ready. Those repos are already sourced that are now starting to come back in the market we haven't had before. So I think dealers continue to struggle with just the internal cash flow needs of a dealership, where they're augmenting with finance, floor planning, but it's the inventory piece. You have to have something to sell.
Thank you.
Yeah, I agree. I think there's two things that in visiting with dealers today, and really for the last 2 or 3 years with the advent of used car prices being really high. And the fact that, at auction they're paying a lot, and then sometimes the lender's programs may not match those advances and catch up with the book, so to speak. While we've come off a little bit from the highs, it's still very high. So I think that was the first thing. The second thing that's sort of recent, or within the last year, a real step up in regulatory and compliance. And the fact that a lot of us lending institutions have really buttoned up processes in terms of controls and making sure the paperwork's all clean and that type of thing. From a regulatory standpoint, that impacts the dealers, and it obviously can impact the dealer cash flow. So those would be the two biggest things.
I happen to agree. I think that the inventory matching to the programs is obviously a very important piece. But the regulatory and compliance, just to add to what you were just saying, you know, we've got a new sheriff in town, the Consumer Financial Protection Bureau. And although dealers were not included underneath their perusal, they're going to get to you through finance companies. They've stated as such. And so they're putting on additional pressure and compliance requirements on banks and finance companies in order to get to you guys. And so, as you mentioned, that we're seeing more and more compliance. We now have, we've always had a lot of state regulations that we've had to deal with, but now we've got the federal government that has become very, very active, and we're going to see more of that. We've only seen just the very beginning of that.
Alan?
Good. Yeah, really two things. First is probably just trying to just stay ahead of the ever-changing trends. These guys talked a little bit about compliance, and I know spoken quite often with Steve and Mike about the legislative efforts and being able to keep informed, and I hear that so much in this space as far as the dealers remaining compliant and keeping up with the ever-changing laws and legislative efforts. And I think that's all too many times overlooked by a lot of the independent dealers in some spaces. Certainly would encourage you to stay connected to your local state associations, to be very aware of those changing environments. And I'll speak a little bit from a floor plan perspective. I think what we see a lot of times is the most frustrating stories from dealers is that they're looking for a consistent relationship with their lender. And being aware of the expectations, a lot of the products and service and offerings that lenders can provide that they're not aware of, and knowing that building that relationship with, whether it's on the commercial side or whether it's on the consumer side, is so all important from a long-term perspective of being profitable and doing what ideally would meet the needs of the business.
Well, I appreciate that. I think what everyone's learning here is that you're a partner and you need to be treated that way. And I don't think the industry treated lenders that way 10, 15, even 5 years ago. And I think what we learned after 2008 is that we have a lot of folks, you guys, committed to us. That's a big commitment. And we needed to learn to give back the same commitment. So I think relationships are absolutely huge. I appreciate that. Yeah. Thank you. Doug?
I'd say it's pretty consistent with what you've heard so far. There's no question about it. Regulatory conditions have really affected what we've done, and of course your jobs out there as well. A lot of the larger independent dealerships, they may have had an office person now, and a lot of you have had to invest in having a full-time compliance person or department set up. We've had to do that as a company. It's one of our biggest cost components over the last couple of years is increasing the size of our compliance and due diligence because we have to make sure that we're doing things right, that we're taking in the right deals. What that has done is it has actually put for the paper that is compliant and good paper, it's really increased the price of that paper. So I think the biggest problem that I've seen is the regulatory issues that are out there and making sure that everybody's doing things right. That coupled with the increase in the cost of inventory has really brought down some margins, I know, with a lot of dealers, and it's made it very difficult. So that's what I've seen.
Thank you, Doug. Mark?
Yeah, same here. I mean, and I've always been taught that the gross that you make on a vehicle is based upon not what you sold it for, but what you bought it for. So the the acquisition of inventory has been what I've seen the biggest struggle for dealerships as far as price is concerned. And so as far as the regulatory issues, yeah, we've seen a lot of that. I've seen a lot of that come up in the last couple of years or so. The good news about that is, I mean, there are solutions to that. I mean, there's costs associated with that, but there are solutions where you can invest in that'll help out with that. But you can't really invest in solutions that'll help you buy cheaper cars, right? You're out there fighting in the auctions or wherever you get your vehicles from. The good news is that you can offset some of those increasing costs when you're purchasing inventory through the relationships you have with your lenders. Right now, it's been very, very competitive with money being so cheap, with creditors coming in. So you can there's room for you there. And also, when it comes to all the software that's available for dealerships, that's becoming lower price for everyone else. And so, so you can make up the loss of gross on buying the vehicles with all the other relations that you have that runs your business or that help you run your business.
Yeah.
Great.
I'd like to add, portfolio performance is really key to the relationship, and as your portfolio does better than your peers, then the finance company is going to do a little bit extra for you, and that means a little bit of extra advance, maybe a little bit weaker credit, and the like. So at Nationwide, we look very closely on a dealer level basis what the portfolio is doing, what your portfolio is doing, and that's a big part of the relationship.
Martin, I appreciate that, and I think that's an area where we could use some improvement. I find across the country, when I speak with dealers about their relationship and about their portfolio, they don't understand how they're performing. The reps don't share that information on a regular basis, and I say, well, you need to ask. I think my point here is that they shouldn't have to ask. We should have consultations with dealers, show them what their portfolio looks like, show them what's important to you, their look to book, cash to approval, things that matter, and show them where it is and where you'd like to see it go, and how you can help them effectuate that.
Yeah, I agree. I think that a lot of the finance companies, Nationwide included, we could do a whole lot more with regards to that. I mean, we do have the statistics available, and they are there for the asking, but it's not one of those things. I mean, if the book to look is way out of whack, we're of course going to be having the discussion about that. But in terms of the overall portfolio, yes, the buyer is going to be talking to the dealer and the dealer representatives regarding the performance if it's not performing, but you should also know if it's performing well.
Especially if you're going to lend greater consideration to that dealer because he's performing well. And if he's performing well, he expects to have that phone call with you when he says or she says, I need a little help, right? I need a little more money. I need less of a fee. I need a better interest rate. And I deserve that because my portfolio is performing well. So I think it offers a lot of encouragement to the dealer to increase the quality of his portfolio if he understands there are benefits to increasing that quality. And when a dealer looks, I think it happens quite often, a dealer looks at a deal and he even knows or she even knows that it shouldn't be financed, and they're sending it to you and you approve it, and they think, you know what, this customer's not going to pay. Now, if they're considering the performance of the portfolio, they may say, you know what, the gross is good, it's not worth harming my relationship. You guys agree?
Sure.
Okay.
I think one other thing, though, is not just, we've always tracked profitability. We've always had scorecards. I think we could do a better job of sharing some of that information out with our dealers, no question about it. I know at Chase, we've now recently sort of taken that to another level, because when we're looking at sort of dealer performance, from our perspective, it's not just, is the book to look okay and those types of standard metrics, but it's also the consumer experience, okay? It's the experience that consumer has, the number of complaints that they have, the Better Business Bureau rating, those types of things. And so we kind of follow it, far beyond just the financials. And that's, I would say, fairly recent in the last, year or two. we've done that.
I think that's great.
Yeah.
I mean, you're looking at the overall quality of the dealership, the quality that the quality experience that the customer may or may not be receiving because you're partners, right?
Exactly.
And that should directly reflect in the portfolio quality.
Absolutely, absolutely.
Great. Well, this is super. It wouldn't be fair, Joe, if I went to the next round of questioning and let you start. So I think I'll start from the other end.
I'd already read the question. I was ready.
What's that? Okay. A similar question. And dealers, I'd like some involvement from you here, if you can, once they answer. If we can get a conversation, I think it would be apropos. Folks on the panel, I would like you to answer this. In your opinion, what do dealers find most frustrating in their dealings with financing and the financing process? And how might we ease these frustrations through venues like this? Mark, go ahead.
So my findings that's been frustrating with dealerships has been basically inconsistent lending practices from some of the lenders out there. I mean, right now, I mean, it's an auto finance boom, and so there's tons of competition or auto lenders going in and fighting another for market share. And some lenders, what they'll end up doing is buying their way into the market, and so they'll go in there and give large advances, get the dealerships excited about their program. And all of a sudden, 2 months into it, 3 months into it, and they start seeing static losses going up, and they start tightening up their buying practices for that dealership or that market. And so then the dealership was excited about that relationship, starts building their inventory for that lender, and all of a sudden starts seeing the constraint of the program being tightened up. So I've seen that. To offset that, I think it's good to have relations with 3 key lenders for your business. If you have all your eggs in one basket, then and you have a good relationship with that lender, then that makes sense if you had a relationship for years. But it's good to have diversity as far as maybe 3 strong lenders in which you can not give equal shares of your volume to, but keeping them interested and keeping them happy with that, where you can build a portfolio with them, where they have enough volume to actually say, hey, your portfolio is performing this way. And then after that, and it goes into the topic that we were talking about before, that when you do have that, really express that you want a relationship with the lender. The lender's definitely going to be there and wants a relationship with you. And if the lender's not giving you, their scorecard as far as how your portfolio is performing, ask. You'll be surprised on how the lenders will be very happy to talk about your performance, because ultimately the lender wants to keep you for the long run. The lender's not going to stay in business if you go out. And so if your conversation is, hey, how can I send you better business, the lender would be very, very happy to talk to you about that.
I appreciate it. Doug.
Yeah, absolutely. Same here. One of the things that we've noticed just along those same lines, we're in a different type of industry. They do primarily point of sale. We purchase products from dealers after they've held on to their receivables for a couple of months. But we see the same thing where you have, especially over the last several years, you've got a lot of hedge fund money coming into the market, a lot of people trying to do this, and they're overpricing portfolios, and then once they find out that there are problems and static pool analysis are telling them that they can't continue to pay that same rate, they're coming back down. Along those same lines, one of the biggest things that I hear across the board, no matter where I go, no matter where I travel, we're in 38 states, the biggest thing I hear problem with a dealer is when they've sold their paper and they've received customer complaints because of it. It's just a very common thing in this industry. A lot of companies out there don't understand how to handle that transition process. And the customers that we deal with, the buy here, pay here dealers, they build their reputation on having good quality customer service and having repeat business. And if they sell their portfolios, and by selling their portfolios, they're upsetting their customers, it's not worth it at any price. It really isn't. So that's the big thing in our industry is handling that transition process for the dealer to make sure that the customer is happy and continues to go back to that dealership. There's a few things that you can do to make that happen. We've put a lot of money and a lot of time into making sure that that happens. One thing that we do, we record 100% of our phone calls. We have a quality assurance department that does every call that is made, they're listening to the collectors on the other end. And the collectors are actually graded by the tone of their voice. When we take over a customer from a dealer, it's our customer, but we still treat it as the dealer's customer. I mean, it's both of our customer. Because the only way this works is if that customer is still happy with the transition process, if they're still going back to the dealer, they're still buying vehicles, and they're still telling their friends about the dealership. So the biggest problem that I see out there is when I talk to a dealer and they don't want to sell their receivables, usually the follow-up is, the reason I don't, 10 years ago I tried it with this company. 15 years ago I tried it with that company. There are so many companies that come into this for the short run. They're in for 2 or 3 years and they're out of it. If a dealer has experienced a transaction with one of those companies, that's typically what they found is a problem with the customer complaints in the transition process.
Thanks, Doug. Alan, how about the floor planning business? What do dealers find frustrating with that industry?
Yeah, it's funny, LJ. There's we talk a lot about being a car dealer. It's not easy, and we try to understand that through our company. So many things going on, and certainly we don't want to take the approach of being another cog in the wheel. And one of the things that we've found over the last few years was, there's got to be a consistent approach to our relationships with our partners and being able to provide them the products and services in an ever-changing environment and making sure they're informed. And I think one of the things that we're able to do is tailor relationships and finding that we meet the needs through some of the flexibility. It's not a black and white program. Sometimes things change in the business model. Some things change in the marketplace, and they affect the flow of cash within the business, sales. And we understand that on the turn of a dime, that companies like NextGear are able to make some of those changes on the fly, and really understand that long-term it's a partnership. It's not just a customer relationship. And hopefully there's a level of consistency that's out there with all of our markets through our service center approach and the service levels that each of our customers are going to receive.
Thanks, Alan.
Yeah.
Martin?
I'd like to pick up, Mark. I think you spoke very well to some of the frustrations with the knowledge of what the finance company programs are and what is it that they buy and the consistency of that. That gets back to the relationships that we were just talking about before. If you have way too many finance companies, it's going to be hard to remember, okay, this is for this person's program, this is for this person's program. And boy, if I'm in with this particular finance company, oh yeah, I need this extra piece of paper here in order to go into the funding package. So I'd like to expand just slightly on what you said in terms of the funding requirements, because that is a big problem and frustration, because you spend all the time, you package it all up, you get it to the finance company. We want to fund that deal as fast as we possibly can, because we don't make any money until those things are booked, and we want to turn around as fast as possible. And I know it's frustrating as heck when you get the call back and say, we're missing the pay stub, we're missing this extra form and the like. So I would encourage you, have your relationships built, have several of them, but don't have it so much that it's unmanageable, so that you're not familiar enough with what they buy and the consistency, both on the underwriting side as well as the funding requirement side.
I think people move towards pleasure and away from pain. And if we can make it easier, not that we can, but as providers, service providers, as lenders, if we can make these things easier, I think our share goes up.
On the back of our program is a checklist of everything that's needed, but that's not good enough, because the people in the box have to remember that, okay, for Nationwide, there's that, and they may have a different form than Chase or Westlake. I mean, these are the types of things that frustrate the dealers and, of course, frustrate the finance companies. So one last check before that package goes out would be very helpful.
I appreciate that. You know, one of the things that is certainly frustrating for dealers, and statistics from NIADA show this, the majority of our dealers have 3 to 5 employees. The majority of our dealers don't have a finance department. And you speak of compliance, and you know, as many regulations as you have on your particular organization, in your institution, the dealers kind of have as many in different ways. I mean, we're very highly regulated. And so you take an organization with 3 or 5 people that sells 30 cars a month, and they're trying to package deals, they're trying to become compliant, they're trying to comply with risk-based pricing, adverse action, the whole gamut, and there's 3 to 5 people, and that likely that person who's delivering the car is packaging the deal, takes out his own garbage and cleans his own windows, right? I mean, these are the folks, they're the bread and butter of this industry. Right. And so it's tough, and they work 80 hours a week, am I right? You guys work a lot, right? So it is tough. I think that's one of their frustrations as well. Macy, let's hear from you.
So at Chase, we fund probably just over $2 billion a month in volume.
With a B?
With a B.
Wow.
40% of those contracts have something wrong with them. So, and then that delays the funding, to your point. But I also want to make a point that from a customer standpoint, that the dealer and the lender are linked together. And the customer views us that way. And so if the paperwork's messed up and they get delayed and they can't get their title work or whatever the issue is, they view us the same way. And then I think we were talking earlier about even the collection process. And we've had a total transformation in our collection process, all to treat consumers the way they should be treated. Which really caused, frankly, a rise in our delinquency, not a rise in our loss, using more of a carrot, I guess, than a stick. Mm-hmm. And so what's happened with that is all the surveys, everything has shown that things are the loss rates are still very good, no issues there, but we have happier customers, and so the customer views us and the dealer sort of linked together.
Agreed. Very well. Joe, floor plan business, right? What frustrates people?
I think it's more of a general concern. It kind of can apply to all of us. It's communication and ease of use. We need to be able to share what's going on, understand your business model so that we can best fit within your operating model. And you need to understand kind of our restrictions as well, what box we're having to come from. And if we don't have that level of communication, it's very frustrating because you have to have that predictability. If you're a dealer that heavily relies on a floor plan, you need to know what's going to happen today, tomorrow, and next week, next month on that floor plan. You need to know that money is going to be available if you're in compliance.
Well, I'm a dealership consultant, so I spend most of my time inside dealerships, and I have a great relationship with the lenders, so I try to bridge that gap. You talk about behavior and understanding relationships. A dealer will say, I had an audit yesterday, and now I'm at the auction, and I bought 10 cars, and I'm locked out.
Right.
Okay? And I said, maybe you might have saw that coming, right? And which is what you think, right? I mean, you guys know you sold the car.
It can be both.
Sure.
I mean, it can be a mistake in the office where it's human error, and all of us have that. But if you have that framework of communication, if you're at the auction trying to floor those 10 cars, you can call the person you have the relationship with and say, hey, look, this is what happened. Mary is in the hospital, her kid's in there. I'll pay this online, or let me pull out my smartphone and take care of it.
So Mary in the hospital, that's a good one. You guys might want to write that down. Okay?
Yeah, if I see that in collection notes, I'm going to know something's up. But just having develop that framework, we really focus on trying to understand your business model and be a partner to you. And we want the same thing. We want you to ask us a lot of questions. We want you to understand what our mindset is so everything goes smoothly, so that you can go forth, operate your business. You're the expert at running your business. We just try to facilitate that.
LJ, I would add that it's all part of that setup process I mean, even for the new relationships, whether it's the consumer side, you're walking into a floor plan relationship, not understanding I'll call the ins and outs of the way that's supposed to work, whether it's a funding packet, whether it's how to conduct yourself during an audit with those expectations, your first experience is going to be very distasteful. I can assure you that. So taking the time to ask all those questions during those setups, if you're unsure, I can assure you most of the relationships with the lenders out there are going to want to take the time. We've learned so many valuable lessons from being disconnected and looking at it from a different lens from 2008 that we certainly appreciate that much more today than we did 4 or 5 years ago. And I'd certainly encourage that if you're having those issues or if you're just getting into one of those relationships, take the extra time.
I appreciate that. I think it goes without saying the primary responsibility to share information is incumbent upon you. Dealers don't always know what questions to ask until they're confronted with an experience. And then they say, now what do I do? And I may get that call. You know, maybe it could be a dealer that's out of trust. And he said, you know what, how do I move forward from here? And I say, here's the deal. We move forward with good communication, and you can work through this. And most of them do. I mean, there's often frozen capital in their dealership, contracts in transit, something that's a little out of whack. And contracts in transit because they couldn't package their deals to their lenders right, and they have this bottleneck of $200,000 or $300,000 in contracts due, and then they can't pay the floor planner. And the floor planner says, you know what, here's our agreement, 72 hours, whatever it is, this is our agreement. I'm not funded. They call me up and say, look, I don't have the money, I just got audited, I have $300,000 in contracts in transit. I said, well, what's the problem? And they say, well, it's my contracts in transit. Right. I said, let's fix it, it's broke.
Not transiting.
It's not transiting, it's contracts in stock,
Yeah.
right? Dealers, I'd like to hear a little bit from you, please. Is there anyone here today that's currently frustrated with a lender relationship? Okay, I knew there would be a few, okay? I don't want to beat anyone up here, but I certainly would like to hear what's frustrating you. Joe Lascota is moving through to answer the first question.
Thank you. Good morning. My name is Morris Smith. So the areas of frustration I have with our lenders, or some of them I should say, is one, fees. Don't beat me up on the fees. At the end of the month when I look at net income and what the dealership made and what I paid in fees, some of the lenders wind up making more money than I do. Pay me my money in a decent time frame. If we submit a package and all the steps are there, send me my check within 3 days, or the ACH. If I have 10 deals with you, don't say, well, we can only approve 3 deals at a time. You have to round robin it. We only have so many processors, so we can't approve all your 10 deals at once. And basically just pay them all at once. I don't know how else to say it. I need my money. If I'm doing what I need to do, and I keep hearing about partnerships, well, partnership means the lenders need to do what they need to do to meet my need as their partner or customer, because I really look at it as a customer relationship. Thanks.
I appreciate that. And I think dealers believe that lenders don't want to fund contracts. Have you ever felt that way? Like they'd like to hold on to their money? So it's nice to hear Martin say we want to get it funded because we can't collect until we fund on it. But I think that's how dealers feel, is that you as lenders or the lender group does not want to come off the money. And I've heard from dealers, whether it's valid or not, that lenders will nitpick things in the packaging and send it back, and we've sent it back 2 or 3 times before it got funded. Of course, the dealer needs to take some responsibility for that. And I'm not sure that what they believe is actually true. But we heard from a gentleman who says funding, certainly an issue, the time frame. I think, I appreciate you not mentioning the lender's name, but maybe there are better lender relationships because I don't hear that all the time with every lender. So something about the relationship. Martin?
LJ, I'd like to respond with regards to the fee comment. As a lender, when we're looking at the quality of the credit for that application, what we look at is what yield do we need in order to be able to come out, okay? And we get that yield in two different ways, right? We get it through the contract interest rate, and we get it through the discount or holdback. And so, again, getting back to the communication that you just mentioned and the relationships that we're talking about, that's when those conversations need to have. If you're not with a lender that you can't pick up the phone, talk to that buyer and say, you know what, I've got a little bit extra in this car, or, you know, because of whatever, and I need you to lower the fee, what we're going to do at Nationwide, we're going to say, okay, that's fine, but we're going to have to increase the interest rate in order for us to obtain the yield that we feel that we need on that credit. And so there's that give and take that can take place. So I urge you and encourage you, and it's not just Nationwide, other finance companies will do the same thing. I encourage you to have that conversation with your lender, and if they aren't flexible that way, then you need to get with some lenders that are.
Go ahead, Doug.
You know, those are all great points. You know, with the fees, you know, you really should have a lender where everything is disclosed up front. You really want to have everything up front disclosed so you're not blindsided by anything. Funding quickly, obviously, is huge in this market. It's all about cash flow. And I would, you know, when you're going through lenders or building your book of lenders, you know, that's obviously one of the things that I would require upon the lender. And being paid all at once, you know, if you've got contracts that fit those criteria, obviously that's, you know, that would be a big priority for that lender to pay you on all the contracts that were approved and are ready to be funded. You know, we do all of those things. You know, the difference is it requires you to hold on to your receivables a couple of months before you sell them to us. That's another alternative. You know, if you want to have a situation where the fees are all disclosed up front, you're funded quickly, and you know, there are no hassles, that's a great alternative. You know, hold on to some of those deals and find another alternative, somebody that will pay you on a bulk basis for all of those loans.
Go ahead, Mark.
Yeah, on the fee part. So you have to understand also, it's such a competitive environment as well that lenders don't also want to overcharge on fees outside of pricing for risk. I mean, that's what the fee is for. And so lenders are very fee sensitive right now in the sense that, hey, pricing is one of our competitive advantages, right, to be in the market, to have some kind of market share. So you're in a good spot when it comes to fees. Now, I've been in the business for a very long time, and you know, I've seen, you know, the ups and downs, and fees are never low enough, right? No one ever goes like, oh man, you know, I got a really low fee on this deal here, on every single that I got from this lender. So that's always a consistent thing. But the key thing is understanding why that fee is there, and that fee is definitely to offset risk. And different lenders have different ways of looking at risk. That's a key thing too, is that some lenders may look at you know, a thin file as higher risk than a person that had a recent repo, or another lender might look at it vice versa. So it's different palettes also by lender on that. And so the understanding of the fee is key. But to the point that was brought up from before is that relationship. If you have a good portfolio with the lender, they will do everything possible to get that fee as low as possible to meet the lender's expectations on yield. And they'll do that for you because they want to make sure that you're consistently sending them business. So you have the upper hand when it comes to that in that relationship. As far as fast funding is concerned, you know, there's the companies that are up here have cash to give out. I mean, they just want to loan out the money, and the faster they do it, the faster they make their money. I know I have pressure to make sure that our sales department goes out there and, you know, gives our finance department and our accounting department issues with funding. And they're saying grow, 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 grow. So when it comes to fast funding, you definitely have control over that. The key thing is here is that you have definitely control over the fees through your portfolio. You have control over the fees with the people that you do business with, and you have control over how fast you want to get funded. You have control over that with submitting the packages that are complete and that are probably pre-verified to help you with that. The last thing the lender wants is an aging contract on their desk. It's just they're not making anybody. It's operational cost for the lender. And if they don't buy it, or if the lender doesn't buy it, or if we don't buy it, there's no money to be made. So you have definitely control over that. But to Joe's point before is that I think that's a communication issue. When you do have that, communicate that with your account manager. Communicate that with management in the company, and you'll get the clear answers that you're looking for.
Well, I want to thank you for that question. By the way, any question that gets an applause tells me that the whole audience feels the same way. Yes. So I do appreciate that. Georgia, we had a couple other frustrated dealers. We may have more than raised their hands, but can you find one and can we ask another question?
One of the areas that we're frustrated with has to do with repos. When the car gets bought back, sometimes we're not communicated with timely. We find out the car's at the auction, it's too late for us to do anything about it. A couple of the lenders that we work with are on the stage. I'd be curious if you could talk about that. One of the feedback we've gotten is, well, that's a headquarters thing. A different department deals with that than the salespeople. So if you guys could talk to that, that'd be great.
Just to clarify, when you mean repos, do you mean is it off recourse or during a recourse process?
Usually it's during the recourse.
During recourse process. I guess I'll answer that then. So during the recourse process, if there is a repo, I don't foresee it going to the auction first because ultimately we want the car to go back to your lot so you can send that deal back to us again. So if it's our company, I would definitely love to speak to you on the one-on-one. We have the lender one-on-ones through from 105 in Milano, 1 and 2. We can definitely discuss that. We do have a program that is a full recourse program in which we understand that the inventory, the asset, is very important to the dealership, and where we want the dealership to have complete access to that unit via tracking the GPS, or even after the car has been repoed to go straight to your lot. I mean, the faster you can get to it, the faster you can recondition and sell it again. So I think that's more of a communication thing, and I can handle that one-on-one with you and go from there. Because ultimately, we never want to put a dealership, and I think any of us here want to put a dealership in a predicament where they've lost control of the asset that belongs to them. Right?
Anyone else?
Well, with regard, nationwide, we don't have a recourse program. It's all non-recourse. But in terms of general repossessions, there is the legalities that we have to have a commercially reasonable sale. Mm-hmm. So we're going to be bringing these things to the auction rather than going to private parties to make sure that we're covered that way. We used to, years ago, I mean, we've been in business since 1954. Years ago, we used to notify the dealers when the cars were repoed. We found that the majority of the dealers, and please, if things have changed now, let me know, but we found, they said, don't bother with it. We're on to the next deal. And so, we stopped putting out those notices to the dealers that the cars have been repossessed. I mean, it's going to go to auction anyway, so I'm not sure, what advantage that's going to have in a non-recourse program.
Does that help understand some of their situations? And if not, like I said, Mark invited you to spend some time one-on-one in Milano between the hours of 1 and 5 today. Joe, here's the thing. You guys, you and Georgia are tied 1 for 1. This puts you up 1, so I'm going to have to get Georgia to hustle up a question on that side of the room. Do you have a frustrated dealer? Okay, go ahead, please.
Regarding the lender was AFC or next year, and when we have the car is released, most of right now we agree, everybody agree this is the subprime deals right now is a majority for us. And when we release the car, then we have something called a bank interview. If the customer makes any mistake with the interview with the bank, then we have to buy the deal back. In the meantime, also, AFC or next gear, they don't want to hear this. They want the car paid. And so we're waiting until they reboot the car again from the customer, or we're missing the first payment, example by Westlake. First payment of missing by Westlake, you have to buy the deal back right away. In these cases, we have a hard time. Either we have to pay the car and we have to reboot the car again to put it in a floor plan, or we're asking sometimes the floor plan to give us a break waiting. But, you know, they say 72 hours, we don't know anything, we have to pay the car. It doesn't matter. Otherwise, we gotta get a bad audit. And then when you get bad audit 2 times and something, they kick you out from the floor plan completely. This is, we wanna find out also what's the resolution for this case.
Okay, if you don't mind, let me recap what I think you're asking. You're delivering a car to a subprime customer.
Correct.
The subprime customer, let's say, fails the interview with the lender.
Correct.
Then hopefully you have a good spot delivery agreement which allows you to take that car back from the customer. But you have one of 2 dilemmas. You either paid the car off and now you have a paid car that you need refloored, or you didn't pay the car off and the floor planner is wondering why. Is that correct?
The case here exactly, sometimes it take more than a week to fund the car. Say, example, the customer calling the bank again, or the bank not find the customer to make an interview, and they take longer to fund the car. In the meantime, the AFC or next gear, they don't want to hear this. They want a car paid right away in 72 hours.
Okay.
I can handle it from the lending side of it, and it's so rolls a car, right? Spot delivery goes into the lender for verifications for them to get funded, right? And I'm assuming that you're saying the flooring company is saying, well, it's in transit, you know, or they don't know it's in transit and they're asking for the car to be paid. I will tell you this is that if you do have if you go through an interview process with the customer where the customer is not available for us to conduct an interview on, all of that for the majority, can be handled up front before you roll the car and say you will be contacted by a lender. They will be calling you. Make sure if you do see 800 numbers or a number from this area code that you do pick up the call. It's not a collector. It is the actual bank that's trying to get you to finance this loan. We see that on our end when we're trying to contact customers for their interviews on the verification side of that. And so you can avoid that situation majorly just by setting the expectation up front of the customer. You will be contacted by this lender. This is the lender's name. They're gonna ask you about the car. They're gonna ask you about the contract and ask you about your employment. Please make sure that you're available for that. If they say, hey, I'm going to be out of town, I'm not going to be able to answer the phone, then you might want to think twice about rolling that car at that moment there, if you're not going to be able to get funded, right, without a verification process in line. And so from the lender side, that would be my comments for you on that.
Mark, I think you're right. Part of this is our process. As a dealer, when we deliver that car, we kind of have to train that customer,
yes,
right? And we have to let them know. And if you are using a good spot delivery agreement, which if it's not good, don't use it at all, but find a good spot delivery agreement and explain it to the customer. Explain the agreement that says, look, there's certain information that I need from you, and one part of it is the interview. Yes. They're going to call, they're going to contact you, and you need to be available. If, in fact, they can't succeed with the interview, they won't fund the contract. And if you have agreed, the dealership and the customer, that 7 days is the time frame that you're allowing for this, if they don't complete the interview process in those 7 days, it's an unwind.
Grounded. So on the lending side of that, I mean, we slice and dice data every which way, and what we found, the time frame from when you when you roll the car to when you fund the car, the longer, when you get funded on the car, the longer that time frame is, the higher the losses are for the lender. Okay? So what we want to, so what we want to do is try to get it funded up front, right, with as fast as possible. But that means there's no stories, everything comes in clean. But the longer it takes, customers out of town, customers, all that stuff, a lot of the times it can be avoidance from the customer, or it can be that they don't have the documentation in line that they need to supply to get the deal funded. And so if you can't get all the documentation up front and you can't get it come in from the customer, your customer, to be available for verifications, you might want to think twice before you roll that car.
Would it be possible that lenders could create such a mechanism where we could actually schedule these things for our customers, actually schedule an interview at the desk, whether it be electronic or something otherwise, or is that not feasible?
No, yeah, absolutely. No, yeah, absolutely. Most lenders have this down to a science where they can see the customer's employment or employment type, right, and how they get, and they know, like, well, they won't be home from this point to this point here. They'll be from work for this point, and we can contact them during this time. We can contact them during lunch hours, and we'll call and set up an appointment for them for when they're not busy to take the call. But absolutely, I mean, there can be an appointment set up front. If you have a good relationship, again, with your lender, you can say, you can contact my customers or my deals within this time frame. Well,
and I think would it help if our funding packages included information that this is the best time to reach this customer at this number?
Absolutely.
And we would probably have greater success if we would do that. So I think that's the dealer's part in their processes, is to do the training and actually lead the customer in the direction that we need them to be led.
Absolutely. So that is shortening it on the front end. And then I think the other half of his question was what to do on the floor plan side. And it goes back to that communication drum that I've been beating on. You know, have your funding notices, have where you submitted, have that timeline. You've got everything in your deal jacket. Explain to your floor plan lender, this is a pending funding deal. I need the customer interview. It's scheduled on Tuesday. That's going to go a long way for them being able to work with you. And if you do have to pay that car off, if you make a decision that this deal is going to come together one way or another, and you own that car, and then it does unwind and you have to ground it, come back to your local rep, your branch manager, or whomever you have that contact with, and request to refloor it and explain the situation. I think you'll find that as long as it's not something that's happening 20 times a month, you should have a receptive audience.
Right. Excellent. Anyone else?
I think just to echo some of the things that Joe mentioned, it's part of that upfront communication and understanding that funding process and a potential uncooperative consumer who walks off the lot without the funding packet probably in some cases may not be suitable for that particular vehicle if it's encumbered by the floor plan, knowing some of those repercussions that do exist. So I think it's part of that process, all the way from what Mark alluded to on the front side with the funding, to ensure all the I's are dotted and T's crossed, to understanding some of those expectations from the floor plan provider.
It may go well if you want to stop by the Milano room for the breakouts, we can have a little more of an in-depth conversation and kind of look at the process for you. And we can do that with you when you're available.
This question is for Alan and Joe specifically. With respect to floor planning, a dealer puts a car down the road, knows there's going to be a funding issue. Maybe, you know, I'm sure they don't exactly know when their audit is coming. But do you appreciate the heads up in the office when someone gives a call and say, look, I delivered this car, I'm not going to get funded for a week, I just wanted to let you know. Is that too much communication? Would you rather wait to hear it when they get audited? I mean, what are you looking for?
Sure. I'll speak to the critical masses. At times it can be cumbersome.
Okay.
There's no question. There's no question that proactive communication in anticipation of some issues to the local representation certainly goes a long way. But at the end of the day, I think that you know, as long as there's compliance during the process, that's the key to it. We find so much of the frustration comes from the dealer being absent at the time of an audit, and an auditor dealing with an employee who's unaware, maybe providing some false information, which during the reconciliation process appears to be some possible wrongdoings, when in case it's not. And we see that so many times, and it's almost like the dealer has to go on trial to prove their innocence, and it's not fair. So I think not only from the principal's perspective, but also the education amongst their staff and understanding in the absence of them being present that some of those expectations are laid out there.
Great answers. Georgia, it looks like you're trying to tie up the score. Huh? Sir.
Hello, I'm Robert Hernandez from San Antonio, Texas. I'm a small independent dealer. And I have two questions. One is for floor plan companies. Do you offer preferential rates for larger independent dealers as compared to us small independent dealers? And if so, this is difficult for us to grow into the business and that also to make it. And regarding finance companies, what we call outside finance companies, the same question. We small dealers feel squeezed sometimes. What does it take to access the big names like Chase out of finance, for instance, to be in the portfolio as a small independent dealer that wants to do good business with you? Certainly companies like Westlake and United Acceptance, companies that do accept business from small independent dealers, and we appreciate that. But the forum today is about new avenues for capital, and we, the small independent dealers, are coming last in terms of customer service. And if you could please expand on that, thank you.
Well, I think that deserves a clap, huh? It's a very good question. I'll break it up into two parts of the question, or two questions in two parts. The first question is, can we get a deal on floor planning? I think that's what he's asking. Are there deals? And the second question is, how can a small dealer do business with someone like Chase? Okay, so let's start with the floor plan questions. Alan, you can start, and then Joe, you can finish.
Sure, I'll take a stab. There's a lot of different factors we look into. I guess to be blunt, is there preferential treatment over large versus smaller relationships? Absolutely not. There's certainly, at least from NextGear's perspective, a tailored approach to suit what things are important to the business model, whether it's the turn time needs extended to help reduce some of the pressures on cash flows. It is a give-take type scenario. What's going to be good for the dealer, what's going to be good for the lender. There's a lot of things that we look at when those types of relationships, the amount of volume being conducted on a monthly basis. We look at, obviously, the credit and the risk perspective plays a lot into that, past performances. Certainly, non-compliance is not going to get you a preferential treatment from rates and and fees, but I would say over a period of time that what we've seen is the level of commitment from the dealer to the lender is usually reciprocated through better deals, and they're certainly out there. There's no question. And I think that when we look at the full picture and we look at things mainly from the performance for ongoing relationships and then for new relationships, some of the things such as years of business, past credit performances, and then we plug those things into a model when we actually look into the specific details of the dealership, average price car, turn times, and then determine what is our yield. And if that breaches a certain minimum threshold to allow us to hit our targets, then certainly that comes into play as far as some of those negotiations.
Alan, thank you. Joe?
I think I really encourage you on how you present yourself to your lender, whether it be floor plan or indirect. Really sit them down and ask a lot of questions as to how your account's performing, the length of time you've been with them, how your audit performance has been, all those historical metrics that we look internally. Gain an understanding of that, and then make sure that your lender understands your business model, because as Alan said, we have the ability to custom tailor our programs, but we don't know your business model yet. We don't know what will best fit you. So at times it can be a bit intrusive. You know, it's your business. It's a very private, personal thing to you, and you may not want to share some of these things, but there's a huge benefit of, if your financials aren't required, go ahead and show them what is going on within your business so that they can get that comfort level and understanding of, okay, if we did this and this for this dealer, he would be able to operate more effectively. We're going to gain incremental business, and now I understand the risk a lot better, so I feel good about it. So really communicate, ask a lot of questions about how you're performing with that person, and then on the converse side, let them understand your business a lot better, and I think you'll get somewhere.
It might be appropriate for you guys to get together this afternoon. Yeah. It sounds like, you know, one of the questions I had, you know, how do we improve through venues like this? And the improvement comes from the communication. Mm-hmm. And it comes from, you know, that's why we set the room up to have, they're draped tables, they're piped and draped, so you can have conversations where the person next door can't necessarily hear what's going on. You can establish a relationship this afternoon. But it sounds like maybe we can offer some coaching, some guidance, and tell people, you know what, we can customize something for you. Here's some of the things we can do. Again, they don't know the questions to ask. And it has nothing to do with their intelligence or knowledge. They're just not aware of what's possible. So sometimes we have to lead them to that awareness.
Yeah. The most fascinating thing about the people in this room is you're all independent car dealers. None of you do it the same way. And that's one of the best things about my job, is going around and spending time and trying to understand your business model better. Because once you have that understanding, then these things start making sense on both sides.
Let me address your question as well. First of all, I want to say that we love independent dealers. We love independent dealers. The relationships tend to be better. We get to know you as the dealer principal better, frankly. We feel like there's more of a trust, frankly, and that type of thing. And I know, speaking on behalf of our company, we wouldn't be here and we wouldn't be sponsoring a lot of these events unless we love the independent dealers. In terms of what we look for and that kind of thing, there's sort of two things. When we first get signed up, we're going to have, and all these things are flexible, okay? But it's generally 3 to 5 years in business. We're going to ask for tax returns. We're going to pull credit bureaus. We're going to pull up the Better Business Bureau. We're going to get all of the appropriate information to initially get you set up. And I'm not sure if you're set up with us or not at this point. Hopefully you will be today. We'll see.
Milano, right?
Yeah, Milano room. Come by. And so there's that piece of it, right? Just getting you started. And then it's sort of learning our program. One of the things we're going to do, though, is we're going to also look at your inventory. So if the inventory is, frankly, if everything on the lot's greater than 10 years old, we're probably not your best source for that. If you do a lot of buy here, pay here, we got a lot of folks up here who could probably help you more with that. So it really kind of depends upon what your niche is. But some of your inventory can change based upon the lender program. We've been talking about that. So there's the first piece of getting signed up, right? And then the second piece we kind of touched on before. You know, how are the customers being treated? Do we have a bunch of dealer complaints or not, or is it really good? We do commodity checks on a non-prime deal. And we want to make sure that the customer was basically satisfied and that kind of thing. And then we follow up with that with auto check events, making sure that, you know, we're not, you know, 80% of what we finance has frame damage, you know. It's probably not a good portfolio. So we do have rules. We do have things that we have to follow. But if we get 2 contracts from you a month, we would be happy. If we got 2 or we got 15, I'd rather have 15, but I'd love to have 2. So doing business with us is just kind of going through those steps, but we love the business.
So would you welcome the whole room to come see you this afternoon at Milano?
Absolutely. We have here, I manage the West region. We have a couple other regional credit execs here, and yeah, we look forward to that. So absolutely.
I'm kidding, but I think each and every one of you would welcome anyone interested to visit this afternoon.
Yeah. And different finance companies have different requirements. I mean, you know, you have your set of requirements. Another finance company like Nationwide, we don't have a minimum amount of years that you need to be in business. We'll pull a credit bureau. We've been doing this a very long time. Over 75% of our business is with independent dealers. So we are, you know, like Chase, we're very comfortable in this space, very used to dealing with the independent dealers. And so every finance company has different criteria. So I encourage you to talk to each of them and find out what their criteria is. You also had a point with regards to rates and whether rates are different between one dealership versus another. And I'm going to use from Nationwide's example a point of sale contract. Ours would be very similar, whether you are from a big franchise dealer or an independent. We're going to underwrite the credit of the customer that you have. Whether we do a little extra for you to do a little bit better gets back to the points that we had before, which is the performance of your portfolio and the relationship that you build with the lender.
I appreciate that. Anyone else? Great questions.
I got a quick question.
Yes, sir.
My name is Gonzalo. I'm with Denver Autos, obviously in Colorado. One of the questions for the panel is, being that we are establishing this new partnership or a better partnership, what are some of the lenders planning to do with the dealerships that do sell, let's say 30 cars a month? And we, you know, I understand that certain lenders will give special privileges or special, maybe a lesser discount, give more money to dealers that send 30, 40 deals a month. But those of us that maybe sell 30 a month and have other lenders and only the panel up there would get 2 or 3 deals, I mean, are we going to be doing anything in this new partnership to, let's say, for example, well, let's start with 4 deals a month, and we'll give you this special privilege instead of being 10 or 20 deals a month, because we don't have those deals to send to get that special pricing or special type of treatment. And I think that if we establish something more to the lesser amount of deals and grow with you, then that's a real partnership, because not all of us could send 30 deals to Westlake or anybody else for that matter. We could probably send 3 or 4. And my second question would be, is sometimes, at least up there in Colorado, there's a lot of the times that we have vehicles that certain times of the year we pay more for. Let's say in the wintertime, a 4x4 would cost us at the auction a lot more than in the summertime. But based on some of you guys' programs, there's no way I could send you the deal unless the customer brought $3-4 grand down, at which point we would keep them as a buy here, pay here. You know, so what are we doing to assist us smaller dealers when we do pay top dollar for a vehicle because of the supply and demand or whatnot? What are you as lenders going to do to assist us and maybe make it a little bit more profitable for us as dealers to move forward?
Okay, thank you for your question. Again, a few questions in there. I think you addressed it, Macy, a little bit with the lower volume. And I'm going to go out on a limb here and suggest perhaps you would take a high-quality relationship, a high-quality dealer that gave you 2 really good, clean contracts a month over a volume dealer that was a hot mess, right?
Absolutely. I mean, we want all the business we can get, right? And I think, first of all, we have a kindred spirit here because you're from Denver. We talked last night. We're both Bronco fans. We both have shaved heads, so that's cool. But I think that one of the issues that you may have when you're only sending a couple and it's sort of spread out, and we've been talking about this, is that you got to understand what that lender's paperwork's like. And that's when you get the rejects and that kind of stuff, because you're not used to dealing. What do they need for proof of income? What do they need for proof of residence? Whatever those things are. And so those are one of the challenges. But in terms of, you know, outside of the things I just kind of outlined in terms of what we look for, you know, we don't sit there and give different rates for somebody sending us 20 deals down the street from you that we give someone else. We do price by market. We price by MSA and that kind of thing. but there's not, we have so many exceptions and that kind of thing we can do, but we watch that stuff really, really close, so.
I think the second part of the question, and if someone wants to take part of the first, you can, and then we'll address the second.
Well,
Go ahead.
I'd like to address, the volume I'm in agreement with. I mean, if we have a couple of deals a month from a dealer, we're very happy with it, and as we said, the pricing would be similar. With regards to buying a little bit above book or buying above book at auction, at Nationwide, we've always had a policy, send in your auction sheet with the funding package, or just, send it over to your underwriter, and we're happy to take that because that's what you've actually paid. That's better than any book that's out there. So if you pay a little bit more for your vehicle, just send in the auction sheet, we'll use it.
I was going to say, we do the same thing. The auction's good for 60 days. After you buy from the auction, that receipt's good for 60 days. So.
Okay, Mark?
So on the advance side of it, so most of us here, it's exactly what they're talking about, is the advance off what the auction is. When it comes to the Westlake side, is that we have our class codes in which are geared based upon the auction values of the vehicles, and then to rank from like 1 through 8, and 1 being the best. And so we do advance based upon what the vehicles are bringing at the auction. Now, on the volume side of it, so I don't know what their average deals per dealership is, but on the Westlake side of it, I mean, we're pretty large in the independents. Our average deals per dealership is a little bit shy than 3. So if you have a dealership that's sending us 4 contracts a month, we're ecstatic. We're saying, this is a dealership that we have a very strong relationship with, and a relationship that we want to foster with preferential pricing, lower the fees with the dealership, and have more room for growth, and obviously send us more business. And so we definitely look at that. You don't have to be a 30 deal a month or dealership to have a good relationship with the lender. You can do the 3, you can do the 4. We understand that from the independent world by far. And so as long as you're consistent with the volume and you're having that conversation with your account rep on saying, how's my portfolio and what can I do to make it better? And I'm sure they'll tell you exactly what to do to make it better. You will get preferential pricing when it comes to that. I mean, it's just like if you scratch our back with good profitable business, then we'll go ahead and scratch your back to make sure that you're getting good profitable business as well.
I'd like to throw in one other thing.
You go ahead, Martin.
Co-signers and co-buyers have really gone down over the last several years. I don't know if you've all experienced the same thing, but when I first started in this business back in the 90s, there was a much higher percentage of deals that came in with other. If you want to help to improve your portfolio with the dealer, add a co. There's no better way to be able to do it, as long as they're not inside their bankruptcy.
I think the problem is the co-buyers are worse than the buyers, right?
Well, but if they're employed, that at least gives a little bit of a leg up, right?
Okay.
And help. Every bit can help. I mean, but if you look at the statistics, when we run numbers, the performance of the contracts that we have that has a co-buyer to them are far greater. So that can really help to strengthen your portfolio and strengthen your deals.
In our world, some people say, less is more. For us, more is more. If you give us 2 people to call and to collect, that's going to give you a better portfolio. If you give us, more steps than we require, my goodness, we'll love to buy your deals and make sure that you get funded quicker. You know what I mean? It's just that's what it is. A lot of the times, the dealerships are looking to, all right, I want to be funded fast. So that means, hurry up, send the contract in, and I'll go ahead and start sending the steps one by one as the contract gets verified. I can't stress enough on how important it is to give as much documentation as possible, even if you go above and beyond of what the lender asks for. That's only insurance for you and your portfolio. And anytime you add a co-buyer, absolutely. I do see this a lot too, and maybe you've seen this as far as co-buyers are concerned. Particularly if they're the spouse or the partner or whatever, if you can add that to a deal, your chances of getting that of your portfolio or your performance being better is significant. Instead of just adding someone on just for the sake of adding them on, it makes it a very good collection tool for us, especially since sadly 50% of marriages are going elsewhere. So when you contact someone, they're more than happy to tell you where that car's at. So adding co-signer or spouses
they will give
is
them
a
up,
good
right?
collection tool.
Oh, that's great. Georgia, it looks like you're trying to even out the score. Let's hear it.
Just had a quick question for you. As I've grown a business, cash flow is always important for every dealership here, of course. You know, a couple people have addressed concerns about getting their money faster, obviously for the sole purpose of having cash flow to be able to do more deals, sell more cars. We all just want to sell more cars. But I've realized as I've grown that ultimately you can only grow as fast as your cash flow allows. And your cash flow only allows you to have enough sales because you're waiting on contracts in transit. We've talked about that. So what is healthy for contracts in transit? What do you see as typical? I mean, I've had relationships with just about every flooring company. You know, they've been great. They've been flexible as long as, you know, you guys talk about a partnership. You know, when we've been good with them and always paid on time, they're good with us. They're flexible with the audits and that type of thing. But ultimately, you have to pay when it comes due. And ultimately, you know, we know those deals are good. You know, as a gentleman over here said, he rolls the deals out because he believes that deal is going to go down. But ultimately, we have to pay the flooring companies and get that money paid off. And, you know, it comes out of our pocket now until we get paid. What do you guys see as healthy for that? Because, I mean, all of us are chasing this magical number of 0 contracts in transit. It's never going to happen, you know. We're always trying to do better at collecting on those and getting those packets perfect and funded. You know, I believe it was Chase that said, Macy said that, you know, 40% of deals have issues. You know, I think all of you would have experience, even the floor plan side or the other side. What do you see as healthy from any standpoint? I mean, if you do 100,000 in revenue in a month, $1 million in revenue a month, what percentage of money would you say is healthy to have out in contracts?
Let me throw this out. As an industry standard, I mean, Joe can attest to this with his 20 group and certified master dealer. Your contracts in transit, your goal, and it again depends on your business model, how much of what you're doing, but your contracts in transit should be no more than 10% of your monthly volume. So we're talking 3 days worth of contracts in transit. Now that's, would you agree, Joe? So, you know, I mean, and that's part of our process. And again, I understand it's difficult when we're dealing with subprime or deep subprime. But sometimes we have to take responsibility in our dealerships for some of that in our processes and our training, etc. But I do understand it's difficult. And you're exactly right. I have seen many a dealer go out of business who was doing really, really well. They ran out of money. All right. Anybody want to take that? Contracts in transit on your side?
You know, it's 0 to 3 days for the prime. I see, you know, up to 5 days for the near, and then you shouldn't have anything, nothing should go past 7 days. There's something wrong. There's something wrong with the package or the customer, or they're with the wrong lender.
Our average funding time is about 3.5 days. That's average. If the package comes in clean, we can turn it around in a day.
Excellent. Mark, you agree with that?
Yeah, same here. Ours is 2.8 to be exact. And
Bragger.
we do fund, yeah. And then about 25% of them are funded same day. Yeah. We just want to get the money out. As soon as we get that contract gets verified, it needs to get out. Believe me, there's heavy push from ownership and from management to get it out quickly.
So it's funny, I think that's an old saying. I was so good at selling cars, I went out of business, right? And how much impacts that cash restraint creates. With those in-transit contracts, you can go from a small operation of 5 to 10 cars and find that you need $50,000 more in operating cash just to sustain the inventory levels. And for those who don't have space in the floor planning world, I'd encourage you to look into some of those options. For those of you who may not have the capacity today, is speak with your lenders about increasing your floor plan lines of credit and understanding that ability to replace inventory, replenish while you have those in-transit items creates avenues or solutions for some of those pressures that you do feel from a cash perspective. There's no question about it. Does it mean every time you go out and deliver a vehicle that the lender is going to expect you to pay off that very second? If it happens with our company, please let us know. We'll be at the lender booths as well. There's certainly some understanding there that that's a reality and responsibility in this industry to know that what's good for you is good for us, and understanding how that world works.
During the lender sessions from 105 as well, to help the contracting transit, from Westlake side, we also have a flooring division that we're working with as well. And so if you're working with a lender that's got flooring involved with it, I mean, there's definitely communication there as far as contracting transit is concerned, and that'll help you manage that better. So I'd be available for that.
And my tip to you is measure it and watch it. Many dealers don't measure it. Folks, you cannot manage what you don't measure. So go home and measure it, look at the lenders, measure their funding time, look at your business, analyze it, and fix it. So if you're not measuring contracts in transit, I think you need to. We are running close to being out of time. Joe has a question here. Georgia has a question there. Let's be brief in answering these questions so we can get these folks out on time. And, yes, we have 2 minutes, Joe said. And let's schedule the rest of the questions for Milano between 1 and 5. Fair enough? Go ahead, Joe.
Great, okay. Our frustration we're having is that we're an internet lot and we have cars from $3,000 to $50,000. And I thank you gentlemen for coming, but the guidelines of your program sometimes don't fit with the car I have. So you won't finance a 99 Porsche with 18,000 miles. You won't finance an 08 Sprinter van with 13,000 miles because you don't do commercial. Why don't you guys, instead of having guidelines, look at the deal, look at the actual individual vehicle. I mean, how could you pass a car that's a one owner with 27 service records, and it's frustrating for us to try and fit who's going to do the program. So again, it's the guidelines are crushing us, you know, from Westlake to Chase, and I had to do a Sprinter cargo van through a credit union because none of the programs would fit because of commercial. So that's my challenge to you guys, to help us out. Sell more deals, look at the actual car, not the guideline of the year if it fits this category.
Why don't you, somebody give me a 30-second answer, and then we can defer the rest of the conversation to the room. Go ahead.
I think we do have guidelines, obviously. I absolutely agree with you that we should look at the customer in those instances. And, you know, your example of the 99 Porsche, trust me, we've done a 99 Porsche before. And so I don't know the details of the customer and that kind of thing. We should talk about it at the lender forum, but we do make exceptions all the time. So I don't know the particular deal. So,
thank you, Georgia.
Basically, my question is about like acquisition fees. A lot of times when we have a customer, all of my lenders we're asked not to disclose an acquisition fee onto our customer that they're there. And it'd be nice to see where we could have more of an open conversation with our customer, because sometimes that'll kink up a deal because it costs us a lot of money to do the deal. Well, you can't tell your customer that, to where if you could tell them, hey, I can't give you the discount you need because to do this deal, it's going to cost me $600, $900, and sometimes that's every bit of profit you have, to where it'd be nice if every dealer or lender would be able to say, hey, yeah, disclose your fees to the customer, even though maybe it doesn't put you guys in the best light, it would help a lot more deals go down because it's a more honest and open communication to your customer at times. And
Well,
more of a comment.
I think that's the tightrope of the subprime business. And you have to remember, as dealers, that's a fee that's being charged to you. And that's why it's not apropos to share that with the customer. It really has nothing to do with them. It's your fee. And it's you know, you're selling your paper at a discount. That's what that fee is. And like Mark said and Martin said, you know, this is to price risk. And we have to find a way as dealers how to structure deals in a way where we can be as profitable as possible while understanding that that fee is part of that deal. And that's the tightrope. That's very, very, very difficult. And sometimes we can get better at that. I know dealers that have really specialized in that and, you know, really enhanced their subprime business because they really learned how to structure, how to price, and how to sell that program. But again, that fee is your fee, not the customer's.
Yeah, I'd be happy to talk to you about that during the session when I talk to you how you can maximize your opportunity with that customer.
Great. Well, folks, we are out of time. If you can give me a big round of applause for our panel members, I would appreciate that.